The issue of insurance bad faith is different from other kinds of issues in business. First of all, an insurance policy is essentially a contract, but the difference in the case of an insurance policy is the economic power that an insurance company has as opposed to other kinds of businesses. People usually come to an insurance company for protection. They come to protect themselves from a loss that they can't handle. Now, whether that's loss from damage to property, or loss due to a medical expense that you can't pay, or loss due to liability in a lawsuit, those are all things that you may not be able to pay out of your pocket. And so instead what you do is you get an insurance policy to cover that, and that way you're paying a regular premium, and if that kind of thing comes up, then the insurance policy is supposed to pay for those expenses. Now, when a person expects an insurance carrier to pay off, they're usually at their weakest. They've just been sued, they have some big medical expense they don't expect, or some piece of their property's just been destroyed, or their health or something has been impaired. In those instances, the person is weak, but the insurance carrier is financially strong. Now that creates a disparity in power, and the disparity in power creates a duty by the carrier. Now this is often referred to as a duty of good faith or a fiduciary duty. The carrier doesn't have the right to take unfair advantage of that disparity. If it does, it's engaging in bad faith conduct. Now, to prove that an insurer engaged in bad faith, all you have to show is that its actions were unreasonable or that they were without proper cause. It's something more than damages for breach of contract. It's tort damages. Now, a tort is an injury to you that doesn't arise from a contract. For example, somebody beat you up, you're entitled to damages from them beating you up, but they didn't have a contract not to beat you up. It's just that they're not supposed to do it. So a tort is something more than a breach of contract. Now, the damages from breaches of contract damages, that's usually you're entitled to whatever you would have gotten if the contract hadn't been breached. And that's it. You don't get things like punitive damages, you don't get pain and suffering, you don't get that type of thing. But tort damages are usually more. So again, going back to a situation of somebody beats you up, you get your medical expenses, you may get pain and suffering, and you also get punitive damages. Punitive damages are damages that punish the person or entity for doing something wrong, and they try to make it so that they won't want to do it again. Now, when an insurance company engages in bad faith, it's like they're beating you up economically. So you don't only get what you would have gotten if they'd complied with their obligations under the policy. That would have been breach of contract damages. Instead, you can also get damages to compensate you for the injury you incurred from their failure to pay. Things like damages for the shutdown of your business attributable to their failure to pay under the policy. And in rare cases, you might get pain and suffering or compensation for emotional distress, and you might also be able to get punitive damages. In some instances, insurers can be held liable for more than breach of contract or bad faith. In the proper case, they can be held liable for fraud, for negligent misrepresentation, for intentional infliction of emotional distress, for breach of fiduciary duty, and there are also statutory grounds to sue an insurance company. For example, you can sue them for unfair claims practices. You can sue them for unfair competition. You may be able to sue them for racketeering if they engage in the same kind of conduct more than once. Now, a lot of these are grounds for more than just contract damages and punitive damages. It's the inherent inequality between the power of the carrier and the power of the consumer that justifies these claims. The laws come to recognize that inequality, and so it's set up a bunch of rules to help sort of even the playing field. Just some examples. If you look at policy terms, there are provisions in an insurance policy. They say what's covered and what's not covered. Well, the provisions of a policy that say what is covered are interpreted broadly in favor of coverage. and the provisions of the policy that say what is not covered, those are interpreted narrowly. So if the policy doesn't clearly exclude something, then it's covered. And if there's an ambiguity in the policy, since it was drafted by the insurance carrier, the ambiguity is interpreted in favor of the insured and against the insurer. Now, there's also a type of insurance, a liability insurance. And over the years, a lot of liability insurance companies would take a premium from one of their consumers and then go ahead and they'd use their power to refuse to defend their insured in a case where the coverage was questionable. So the law developed a rule that says they can't do that. Where there's even a potential for coverage now, the carrier is required to pay to defend its insured, even if it ultimately turns out that the liability wasn't covered in the first place. This makes the duty to defend very strong, even stronger than the duty to pay if the insured's found liable. The failure to defend an insured where there's a potential for coverage is bad faith. So there are some limits on insurance coverage. For example, a policy won't protect you against your own intentional acts. Like if you go out and beat somebody up because you feel like it, you don't get coverage for that. And that's because the law doesn't want to encourage people to do bad things by letting insurance protect them against the consequences of their own bad acts. But for most people, that's not really something they're going to need to be concerned with, because very few people are going to go buy an insurance policy because they want to go up and beat somebody up or shoot somebody. When you get insurance, it's usually to protect you against something over which you don't have any control, like an accident or something unexpected. In those instances, if the insurer doesn't live up to its agreement, you usually have some very strong rights to make it do what it should have done. It might take some time to vindicate those rights, but it's good to know that you have them and that there's something you can do about it.